Hello and welcome to the Financial Aid Informational Series presented by Upward Bound Shelton and the Capital STEM Alliance. My name is Riva Villa and I am the director of Upward Bound Shelton. For this video, we're going to talk about student loans. But before we begin this video in earnest, I'd like to tell you a bit about the Upward Bound program. TRIO Upward Bound is a federal college access program established in 1964 under President Lyndon Johnson's administration as a response to the Civil Rights Movement. The Evergreen State College was awarded the institution's first Upward Bound grant in 1977, serving students in Tacoma. Evergreen now has 5 Upward Bound grants serving Tacoma, Lakewood, and Shelton, as well as 2 college-level TRIO grants. Upward Bound provides a variety of services to students in the districts our programs serve, including college application and enrollment tracking, assertive advising, tutoring and mentoring, support with college admissions and scholarship essays, advocacy, exposure to diverse cultures and college campuses, opportunities to gain student leadership experience, and of course, assistance with financial aid applications. Today, I plan to talk about subsidized versus unsubsidized loans and Parent Plus loans, interest rates for student loans and other forms of credit, the difference between federal loans and private loans, loan rights and responsibilities, and what you can do to pay back student loans. Just a heads up, much of this video will contain vocabulary that may be unfamiliar. So here's a review of some relevant terms you may hear throughout these videos. FAFSA is the free application for federal student aid. It helps low-income students afford a college education by determining a family's EFC and supplementing it with grant and loan offers. The FAFSA must be completed annually for students to receive continued funding for each year of college. EFC stands for Estimated Family Contribution, which is the amount the federal government believes a family should contribute to their child's education based on their federal income tax information. Students can find this on their SAR. A student's SAR is their student aid report. These are the FAFSA results that inform a student of their family's EFC. This is also what financial aid offices use to determine students' financial aid awards. Grants are free money, like scholarships, given to a student to pay for college tuition or other college-related expenses. Subsidized loans are student loans offered by the U.S. government, wherein the government pays interest on the loan while the student is in college and for 6 months after graduation, when payments are required to begin. Forbearance and deferment options are benefits available with these loans, as well as income-based repayment. Unsubsidized loans are the same as subsidized loans, except the federal government does not pay interest on these loans while the student is in college. This means that interest will accumulate throughout the life of the loan, adding more to what will need to be repaid in total. The WASFA is the Washington Application for State Financial Aid. This application functions similarly to the FAFSA, except that it is designed by the state of Washington to help low-income students at various stages of obtaining U.S. citizenship or permanent residency who live in Washington state to afford a college education. However, this application only provides grants to attend college. It does not offer loans to students. This must also be completed annually for continued funding. A Washington resident is a U.S. citizen or permanent resident who has lived in Washington state for at least 1 year and/or has graduated from a Washington State high school. This also includes non-citizens who meet the eligibility requirements outlined by HB 1079. To qualify for House Bill 1079 or HB 1079 benefits, students must have lived in Washington State for 3 years and graduated from a Washington State high school or received a high school equivalency like a GED. CADER are the college academic distribution requirements for Washington State. These are the credits all 4-year state institutions require high school students to have earned in order to gain admission to their schools. MPN is a master promissory note. This is a legal document in which you promise to repay your loan or loans and any accrued interest and fees to the U.S. Department of Education. It also explains the terms and conditions of your loans. In other words, it's a student loan contract. FERPA is the Family Educational Rights and Privacy Act, which is a federal law that protects the privacy of student education records. The law applies to all schools that receive funds under an applicable program of the U.S. Department of Education. BAs and AAs are bachelor's degrees, or specifically Bachelor of Arts degrees, and associate's degrees, or specifically Associate of Arts degrees. Keep in mind that you can only qualify for federal student loans if you fill out the FAFSA. WASFA filers do not qualify for student loans. The 2 types of loans you'll qualify for by filling out the FAFSA are federal direct subsidized and unsubsidized loans. Subsidized student loans are offered based on the student's EFC or estimated need to attend college. The primary benefit of subsidized loans is that the U.S. government will pay the interest on subsidized loans while you're in college, or on forbearance or deferment. Unsubsidized student loans offer many of the same benefits as subsidized loans, but are available to both undergraduate and graduate students and are offered regardless of financial need or income. But the biggest drawback with unsubsidized loans is that the government will not pay interest while students are completing their degree, increasing the overall total of the loan drastically by the time the student needs to be completed. Both subsidized and unsubsidized loans offer lower interest rates than traditional private loans or loans to buy homes or cars. And both offer forbearance, deferment, and income-based repayment options, allowing students to delay making payments on their loans or to make lower monthly payments based on their income. Both loans also allow borrowers to wait up to 6 months before beginning their initial repayment phase to allow time for recent college graduates to become established at a new job or career. Students with a large unmet need remaining after other financial aid resources have reached their limits are often offered Parent Plus loans. These are federal loans available to parents of students to help finance their child's education. These loans are unsubsidized, meaning parents pay interest while their student is in school and throughout the deferment or forbearance periods. However, they do offer some benefits. For instance, they have a fixed interest rate that will prevent interest from increasing over time. And Parent Plus loans have a higher limit, making them better able to meet the unmet need for the student and the family. Regardless, most low-income families do not take out Parent Plus loans for their students to go to school, as it often isn't feasible for the parent to take out a loan for their child and pay on it while they're in school. Although this isn't always obvious to students, parents often pay a large portion of indirect costs for their children while they're in school. Thinking in terms of the bigger picture, there are many benefits to taking on student loans compared to other forms of credit. For instance, student loans offer lower fixed interest rates. You can qualify for them based on need instead of credit history. They help build credit for individuals who are new to the financial world. You do not need a cosigner to obtain them. Interest will not accrue for subsidized loans until after the 6-month no-payment grace period post-graduation. And, as mentioned before, forbearance, deferment, and income-based repayment options are available to increase the flexibility borrowers have throughout the lives of their loans. These loans also take longer to go into default, offer consolidation options, can be discharged on death or disability, and there's no limit for Parent Plus loan borrowers. Loan forgiveness programs have received a lot of attention in the media lately as they are being overhauled to increase access to student loan forgiveness benefits for qualified individuals. Those, such as the Public Service Loan Forgiveness Program, offer students a way out of debt in exchange for their years of service for the government or community. Now that we've had a chance to talk about federal student loans offered by the U.S. Department of Education, let's take a moment to talk about private loans. Private loans often function more like traditional loans. Payments are due throughout the lives of many private loans, even while students are still in school sometimes. You must rely on your credit score to qualify for private student loans. Interest rates may vary by circumstance and may or may not be fixed. This means that the interest rate could increase at any moment during the life of your loan. And private student loans may not qualify for loan forgiveness programs or even take payments from public service entities like AmeriCorps. Another thing to keep in mind about federal student loans is that you have a few guaranteed rights associated with them. For instance, you have the right to accept all, part, or none of the student loans offered as part of your financial aid package. Your student loans also cannot dictate what you study and cannot be revoked because you change majors. And your student loans are yours. That information is protected by FERPA, and it cannot be shared with anyone, including parents, unless authorized by you. But with rights come responsibilities and expectations. Some of your responsibilities as a borrower of federal student loans include accepting or rejecting your loan offers as part of your financial aid package, signing your MPNs, and participating in loan entrance and exit interviews with your institution. Working with your loan servicer 6 months after graduation to develop a repayment plan or to set up deferment, forbearance, or income-based repayment, and keeping track of your loans. Your servicer may sell your loan to another servicer, or the Department of Education may switch servicers for your loans. It is your responsibility to know who is servicing your loans to ensure you're paying the correct servicer and are maintaining a clear line of communication. Fortunately, several programs exist that can help you repay student loans. AmeriCorps is a federal volunteer service program wherein people volunteer, often full-time, for a minimal living stipend in order to earn a large sum of money that is limited to spending on college, like tuition, housing, meals, supplies, and student loans. Another program that will award you with a large sum of money in exchange for service is the Peace Corps. The Peace Corps is an international volunteer program that typically serves third world countries. Benefits include a living stipend, a $10,000 completion bonus that doesn't have to be spent exclusively on college, student loan forbearance and deferment benefits, as well as student loan forgiveness upon completion of your service term. Many know that the military will award money for college upon satisfactory completion of service as well. Federal service in a branch of the U.S. military earns a regular paycheck, and those who complete their mandatory service term earn benefits that cover tuition. ROTC, or the Reserve Officers Training Corps, scholarships cover all 4 years of college and allow graduates to enter the military as an officer. Student loan forgiveness programs allow people who enter into certain careers to have some or all of their loans forgiven in exchange for their service, such as teachers, state or federal government employees, civil servants, medical, dental professionals, etc. And finally, income-based repayment, which allows you to make minimum monthly payments based on your income and what you can afford to pay each month rather than making payments on an amount set by the service term. This option is especially beneficial for people participating in loan forgiveness programs that require a minimum number of payments to qualify. Thanks for watching. This has been Riva Villa, Director of the Upward Bound Shelton program with the Evergreen State College. If you thought this was helpful, don't forget to drop a like or leave a comment. If we find that this has been helpful, we may create more videos in the future. So please let us know your thoughts or other topics you'd like for us to cover about college or the financial aid process. Otherwise, until next time, take care.